quantitative easing that is now just occurring after a massive fall in the stock market, roughly 20% in the S&P 500. Yes, we've recovered a little bit of that, but not anything noticeable. Today, but I'm not looking at that too concerningly. Why am I not looking at that too concerningly? We had two Fed members, as far as I'm aware, speak today. We had Bostic walk back in September a little bit, say not a Fed put. I think that was obvious it was not a Fed put. We're not expecting the Fed to come in and buy at any point. At least I'm not anticipating that. And we didn't see the Fed, besides Boston, which might have given us an initial push, but I think that was more the strong economic data, if you look at whether the moves actually occurred. When Daly spoke, and she spoke relatively hawkish, and this is someone from San Francisco, if you know what's going on in San Francisco, nothing happened here. The 20-year Treasury, which happens as a picture, moved slightly, didn't hit the new highs on the other day, after Daly, until about an hour or so later, and then pulled back down and just continued to pull back down. Now, I don't want to get too much into this, okay? I don't want to get too much into this 20-year Treasury yields moving one day, early in QE. You know, we really got to see how this thing plays out the rest of the time, but the Fed members are saying that the market is anticipating what they're going to do. Despite how obvious Daly was, she said 2.5% neutral, get up to there quickly. 2.5% is, as far as I'm aware, not going to change anything because virtually every rate is above 2.5%. And historically, when the Fed funds rate is around 2.5%, the spread between the 10-year and Fed funds rate squeezes. It gets smaller. When Fed funds rate is on the floor, at zero lower bound, there's a bigger spread between the Fed funds rate and the 10-year Treasury. So, as far as I'm aware, 10-year Treasury is 2.9%. We're seeing some movement there. We're going to have to see that develop. Maybe we hit a new high, maybe we don't. We'll see what happens. But it's entirely possible that the Fed increases the Fed funds rate and the 10-year doesn't move very much. That seems to be what the members of the Fed are saying is likely going to happen. That the market knows what's going to happen. This has been widely anticipated, widely communicated. Last week we saw incredible demand for U.S. Treasuries, $47.5 billion. It's a lot. You and me, we have that in our pockets. We'd be very happy. But in the grand scheme of the market, it's really not that much per month. That's like less than Apple's daily volume. And we're getting that balance sheet runoff from the Fed in a month. It's not that much. Not a long time. So there's record cash in the sidelines. It can stay in cash and earn nothing, or it can go into bonds, it can go into stocks. I think it'll go into one of those two. I think things aren't going to get too crazy. Record cash in the sidelines, not seen since 9/11. Okay. Yes, I don't think it's a phenomenal environment. I don't think we're going to do all that much. But I think the market is correctly priced for the incredibly well communicated Fed tightening. We know what's going to happen until the end of the year, until 2023. We know exactly what the Fed's going to do. Unlikely, highly unlikely, they get more hawkish from here. It's just basically not possible. They took 75 basis points off the table. Yeah, they lost it back. But they're not going to bring it back. Bullard is already talking about reversing course into 2023. He is the most hawkish member. Okay, so that's one pole of the spectrum. He didn't move markets. If anything, he moved markets up. Yeah, we saw a little bit of a spill into the last 20, 30 minutes of trading. We saw quite a recovery off the lows today, which I'm taking more notice of. I say we just have to chill out. We have a long-term time horizon, especially in times like this. And you have to be greedy when others are fearful. And there's a lot of fear, but that's not easy. It's much easier said than done. So part of doing that is actually having a long-term time horizon. Warren Buffett says he wishes stock markets only open up once every 6 months. That is quite a long time. I'm not just looking at saying, oh, we'll buy stocks and check back 6 months from now. No, we're doing our homework every single day. But we buy a stock at what seems to be a good price. Because the market is making a bad deal for himself, making a good deal for us. We're buying stock at a good price. Maybe he makes another mistake tomorrow. I don't know. Okay, I have no idea. Maybe he makes another one next Thursday at 2:53 p.m. Okay, totally possible. Regardless, you just gotta sit tight, sit pretty, realize a lot of this stuff is not a surprise. A lot of people expect the economy to slow. That's happening. I expect that. A lot of people expect recession. I don't necessarily expect that, but that is part of people reflecting the current crisis. A lot of people expect a tighter Fed. That is definitely priced in the market. I can get as high as I can with that. 99.9% continued. That's kind of the crux of this whole thing. Fed is going to tighten, slow down the economy. One after the other, that's common knowledge, it's widespread knowledge amongst the investment community, and I think that's just factored into the market at this point. We're not seeing crazy action today, okay? Despite everything that's happened today, quantitative tightening, daily peaking, kind of hawkish, Bullard saying 3.5%, and then maybe a pullback in rates end of 2023. Despite all that, we are off the mat, and we're not printing crazy day. Today was a 4% down day. We've had 3-4% down days, and it's nobody's business the past 2 months. We're not having that today, okay? I think things are considered. I think we've seen a lot of blood. I'm not saying, well, today's the local low, and 38.15 was the absolute low, although it probably was, in my opinion. It's just not far away enough, 5% away, roughly. Can't say it's low. Whatever. I think prices are good here. ARC, growth, those kinds of companies that are the most beaten down, bottom before the broader market bottom. I don't remember the last time I saw that. I do, actually. I'm saying that because I don't think I've seen the time that's occurred. Because I don't remember. It probably hasn't. The notable time I saw that occur was the March 2020 bottom. I believe the ARC stocks bottom, some March 20. The absolute bottom was March 23rd. So, I think the most hated saying, hey, Tech's not doing poorly today. NASDAQ's the outperformer. So, despite everything we're doing, quantitative tightening, daily, Bullard, dead cat bounce, bear market rally, NASDAQ's the leader today. Okay, what the market's happening. So I think we just have to not worry about what the market's going to do tomorrow, not worry about what it's going to do next week. If you have to worry, and if your game plan is to worry that short term, you should just get cash and invest in some money markets. Nothing wrong with that. If that is what you're, if you have, if that's your financial plan, or you're expecting additional downside, those are good moves, okay? This is a rough time. Nothing wrong with cash. Nothing wrong with money markets. I just have a different view. I think this is a good time to deploy capital. There's a ton of fear. There's record high cash levels since 9/11, and I acknowledge that we might hit new low. That's entirely possible. I have a little bit of cash. I have stock. I can sell and probably aren't going to move that much. If it really gets treacherous out there, I can make moves. I'm not in margin, et cetera, et cetera, et cetera. You gotta have, I'm not saying, go lofty, et cetera. But a lot's happening, and I think things are okay in terms of price. I think things are actually kind of good in terms of price. Some areas, I think it's exceptional in terms of price. So, I think deploying some capital is a